of that. It's not the most frothy if you look at the other commodities. And when you step back and to your question, you look at the macro picture, you see that the moment is like a firework, especially in the US. And so the big question is that just a flash in the pan, and then we go back to a slower normal as the US government itself predicts in their budget? Or is that, sort of the recovery from COVID final, and we have a soft landing, and we grow strong on the back of stimulus money, and it's going to be another roaring 20s decade, real decade? Or is it a flash in the pan, which is more than that because it just ushers in an inflationary period?
I mean, on that point, Christoph, ultimately, the question is, do we stay in a managed economy in the G7 like we have for many years? Or does the G7 return to a laissez-faire market economy?
I don't know. Was there a big break?
Well, the last 10 years has been a managed economy. We're all looking very much like China now.
Well, the money was managed to a large extent. So the big question is, where's the growth engines globally? And at the moment, it's the US and China, and it's the US, the one which is growing fast, and China is decelerating a lot. The payroll report you mentioned, that's the perfect example for this kind of uncertainty which is there. Because payrolls came in at, say, 570,000 plus, and the expectation was 600 something. So say 100,000 less than expected. Market took it in its stride, thought it was good news. When you compare that to what happened last month, it came in at 200 something, expectation was 1 million, 800 less than expected. Just look at these numbers and ask yourself, how come that there's 800, 700,000 missing now, which didn't come in last time, which were not expected to come in this time? And it's a bit confusing picture. I think what it signals, you have Republicans saying, okay, this is because people can't get their butt off their couch. They get the stimulus money. They don't want to work, so spend less. You have Democrats saying, oh, this is a very difficult market. People have to change jobs and move cities and this and that, spend more. And the truth in the middle somewhere, schools not open, summer camps, women not going to the workforce, some people being lazy, some people being afraid of going out of the house because of COVID still lingering, and a recovery which is just not as fast as some pundits would have expected. But having said that, I think this is firm recovery territory, at least in the US, spreading hopefully to Europe and other places on the globe, and no major hiccup in China, even though it's slower than expected. It has inflationary potential. And when you get excited about the oil price going to 70, watch next quarter's US GDP growth. All indications are that it will grow above 10%. I have no idea how long ago that was the last time, but that's what they call a base effect, is because it tanked so much in 2020. But still, the numbers are going to continue to look stellar, and the inflationary pressures building continue to be real.
But Mike, still the engine of last week's price rise, and that sort of moving above 70, I would argue was driven more on by supply management than demand. We had a bumper Memorial Day weekend, but nonetheless, OPEC discipline to hold supply very tight over recent months, and again at the meeting last week, really a big part of holding and pushing above 70. Your thoughts on the OPEC decision or non-decision over 20-minute meeting last week?
Yes, it was a quick meeting, Sean, and I guess I could rephrase my earlier quip by saying certain producers have it, because the global stock draw is still continuing unabated, despite the demand setbacks that we're seeing from places that we've been talking about a lot in recent weeks, such as the terrible situation that we've seen in India. And as a consequence, the market expects OPEC to have done their job and returned global inventories to a baseline, which we mustn't talk about 2020 baselines, because yes, indeed, then we get plus double-digit percentage growth everywhere. But we see global inventories moving exactly as OPEC Plus intended, back to that 2019 average sometime later this year, which essentially, if I want to paraphrase, means that all the spare capacity will sit with those who want to control the price. And therefore, the market has confidence that the Saudis will stick to their successful formula in leading by example and putting back their share, their extra 1 million barrels a day, for example, in a responsible way. And we got the OSPs that came out just a couple of days ago, which showed that also with numbers that were, in my personal opinion, designed to keep consistent with that message that they want to continue managing the market. And of course, Christoph will now chime in and talk about US production. But the fact is that we are still, despite the big increase that seemed to shock people, that the market wasn't expecting 11.2 million barrels a day out of the US in the month of March, which is a little late, but that's the latest data point we have. That is still nearly 2 million barrels a day off the high pre-pandemic. And I see no way that the US is going to catch up in the time horizon that we're talking about in terms of the next 3 to 6 to 9 months, because that's just not possible to mobilize the shale sector that quickly. And as a consequence, the spare capacity will be with the two major protagonists or three major protagonists in OPEC plus, and of course with Iran, which is my segue to the next topic, I guess.
Well, on that point, go ahead, Christoph.
Yeah, let me chime in on that because it's a bit different from what Mike says. I think there's a real puzzle to be solved here, which is that at these prices, we have seen so limited reaction from shale. So what we have the last 15 weeks, the growth rate of drilling in shale was about half as much as big as it was in the 20 weeks before. We have now rigs. I just wrote down the numbers. The 359 currently in the shale patch in the US. Last year it was 800 and something in April 2019, and in January it was still 670. So a much slower response rate. And there is a good article by Kemp, who's a respected and I think good analyst of Bloomberg, who basically says this looks like collusion to him. So a kind of voluntary restraint in a reorganized shale industry, which takes it. If it is, I don't like conspiracy theories. Maybe indirectly that people are treading cautious, and so they will come back. But the issue now is that you have a lag, usually at least 6 months between start of drilling and oil flows, and then usually another 3 to 4 months between price increases and start of drilling. So you should expect very limited shale reaction until the winter, given all these numbers. And it's a puzzle to me. It's a mystery. I think that's something some people should get down and try to find out why that response rate was lagging at these prices and why it slowed down just when prices went up. That's the growth rate falls into half while prices go through 70.
On that point, though, Mike, the idea, and I think some of the majors have stated it, they're going to wait to see the OPEC plus countries putting back more of their idle capacity, that they do not want to be investing in new production in the West Permian and West Texas when there's still 5 or 6 million barrels of idle OPEC supply that can come back a lot quicker. Your thoughts on that debate?
Yes, of course. I mean, just to come back on Christoph's numbers quickly, I mean, the Permian isn't going to get motoring towards that pre-pandemic level until we're at above 600 rigs. And if we're still in the high 300s, that's just confirming what I said. I think the investments, yes, I think the investment attitude has changed massively, because not only have we seen a migration of some Permian assets from independent private equity funded type companies who must hedge to oil majors who don't need to hedge, but those very oil majors are resetting their priorities. I mean, Shell has now shared 4 refineries in the USA in the space of a year. And you're seeing everywhere that the energy transition is taking hold and people are thinking twice before sinking money into projects. Now, if you hedge Permian, that's about as immediate as you can get. So you're looking at a forward curve with WTI approaching high 60s in the prompt, and you can hedge at high 50s or even early 60s in your investment horizon. That would appear to be compelling for those who have lenders insisting that they hedge. And I can bet you that's already been going on. And yet you still don't have the immediate supply response. And even if people do start mobilizing those rigs very quickly and there's just a small lag, and let's say in the next few weeks, those rigs go up by rates that we haven't seen all spring, you're still going to need a lot of time to see a catch up there. And that's why I'm saying that there's a perception in the market that control is with OPEC plus, despite the spare capacity cushion that's undeniably there.
The other thing, Christoph, sorry, go ahead, Christoph.
On the risk of cutting you out completely.
No, please.
But I think Mike has his finger on some. So we may disagree how fast they're able to come back or not. But 2 things are important here. One is that they can hedge so that even if something goes wrong on the OPEC front, these higher prices will be there for them for a while. But the real important thing when Mike puts his finger on is, if there is a puzzle in that they respond to slower than everyone would have expected, How much of that puzzle is due to the energy transition and Joe Biden's policy of, decarbonization and, making all this noise, even if it wasn't very effectual, of cutting down drilling rights, not only in the Arctic, but on federal land, which would affect the shale patch a little bit, of all the pressure on Exxon in the newspapers all the time as shareholders, telling them to invest more into renewables and be more conscious. The European majors basically driving their rates of return against the wall by, making an announcement that they sell the profitable part of their business and invest in the unprofitable utility kind of energy transition. If that is already an impact into the investment behavior of what I would consider the most ardent and studious and strongest investors, probably most convicted professionals, which are in the US, should be much less affected by this noise than the European counterparts, then this is a warning sign. And I want to just relate this to what we know about this energy transition. If it proceeds as that will lead to a concentration of oil investments away from IOCs, from shale, so in the OPEC countries and in the NOC countries, which do not face these kind of restrictions. In terms of an environmental protection, this will relate to what BP already does, asset sales to companies who are smaller and for almost certainly dirtier at operating these assets than the majors where they come from. So we're steering a world where the so-called the West starts itself to make more dependent on highly concentrated production in low-cost jurisdictions in the OPEC plus countries.
Which I think you'll see
already started.
You're already said, obviously, in UAE, we hit 4 million barrels before this agreement kicked off last April and very aggressively pushing to 5. But Mike, not to get too distracted, let's just move a little bit to the last point you mentioned, Iran, because of course, I think that was another piece of the puzzle last week that gave that support and holding above 70 was the sudden sort of realization, well, actually, maybe these Iran talks are not going to result in a deal anytime soon. And as a result, maybe that extra oil from Iran is not going to be coming either. Your thoughts on where those talks are going? They're breaking now. They're due back, I think, at the end of this week. But ultimately, they do seem to be hitting some stumbling blocks.
I do think that this coming week's next round, where the Italian lead on the JCPOA side and the Iranian commentators both hinted that if it's going to happen, it's going to be this coming week, is probably last chance before Rouhani's administration bids farewell and hands over to the next chap, which is going to be Raisi. And the question on people's minds is, does Rouhani have the mandate to concede even 1 millimeter in negotiations from the supreme leader in his parting weeks in office? And the other concern on people's minds is, can the Americans really be seen by a very skeptical House, not just the Republicans, but also some Democrats, making concessions that are too soft? And yes, once the team, the State Department team and the National Security Advisors have been given, it seems, quite a bit of latitude, can they really come away from the negotiation without trying to secure some sort of concessions on Yemen and on, let's call it, proxy activities, which some have talked about sponsorship of terror in other countries, and something on ballistic missiles? And all this talk in the headlines just yesterday and today about possible secret enrichment and the 3.41 kilograms of near weapons grade enriched plutonium that's already there, apparently. It's all concerning to people, of course. And then there's a huge amount of speculation and it's rubbish, of course, going on about there having been 4 accidents in industrial facilities in Iran, or 3 plus a vessel sinking off Karg Island, a naval resupply vessel, that has people gossip mongering that there's some foul play behind the scenes there as well. But back to your question, Sean, sorry, getting there in a long-winded fashion. I've said this before last month, but I think the market has built in a return of Iranian oil to markets later this year. There is a wide range of estimates on how much oil will come back and how quickly the wall of oil will hit us. And whilst we have heard that NIOC are ready to start exporting and to resume exports again, the international banking system, the shipping system will need to adjust to doing so over and above the flows that are already occurring, primarily to, or only in fact, to China. And it is our understanding that the inventory is held both inland, in overseas countries such as China, and on the water in a flotilla of NITC tankers, could be in excess of 100 million barrels, but a lot of that is condensate, which is of a quality, because of its mercaptans, it stinks, and many places just won't have it, is highly limited in how quickly it can enter the marketplace. And therefore, any talk that I've seen of people saying, oh, there'll be 1 million barrels a day straight away in August is complete nonsense, because the market has finished trading the month of July, and August is about to start. And by the time they've hacked out an agreement in the coming weeks and papered it up, we'll be into August and we'll be trading October. So I'd be very surprised if we get
we'll be putting on our fur coats. Christoph, do you want to make any comment on Iran before we go to the survey question?
Yeah, I think there's more to it than meets the eye. So first of all, on the barrels coming back, we do have pretty clear understanding. I think in the order of magnitude, 600,000 within 3 months, 1.2 within 12 months. So that's a realistic thing. And it's not the first time we have this going up and down. That's number one. Number two, part of that is, of course, already on its way. And we all know about the relaxation of the actual sanctions enforcement. So this is going to be a ramping up, but a process, and that's the point here, which is possible for OPEC to stomach, which will not derail the market. And in that sense, I do believe, yes, it's priced in. But then what we see on the actual negotiations, I'm a bit more skeptical. I mean, there's clearly a desire on part of the US to tick that item off the agenda, and it's clearly reinforced by the European Union to being extremely keen to get this done. And historically, this kind of constellation has always led Iran to step back in the last minute and to renege and to do something else. Plus, I do think that these explosions, as Mike said, they are not just an accident. It's not unheard of that facilities get attacked, that nuclear scientists get liquidated in Iran. Happens time again. And this is like the kind of campaign you need to prevent a hardliner shortly before the elections to agree to this kind of deal. And that's exactly what I would think what major decision makers in Israel would like to see, that this isolation of Iran continues. And so I would expect that last minute there will be some sort of Iranian triggered hiccup, and the whole thing turns into the gray zone where the barrels go up without a formal change in agreement, and more or less tolerated better than we have seen over the last months of the Trump administration, when they really try to clamp down. And that then certainly is something which OPEC can deal with without changing its schedule of releases.
We had Amos Hochstein, the former senior energy advisor to the Obama and Biden administration, on the halftime talk last week. And his view was that this isn't going to happen in one big deal, that it'll be some kind of incremental drip. You do this, then we'll do that scenario. So let's see. Survey question. I want to get, before we talk a little bit about next week, this idea I mentioned earlier in the talk this morning is about the sort of continued easing of managed economy, the absence of the laissez-faire market economy that we all grew up with, and if it's ever going to come back. And I think a lot of that will guide where the next few years goes in terms of coming out of this economy. Some people are of the view that the Fed and central bankers are just preparing us for a longer period of higher inflation. And so this talk around inflation being temporary and so forth. So anyway, the question of this morning is, the power of the managed economy has been delivering in China for decades, and it has anchored in most G7 economies from Tokyo to Washington since 2009. Quantitative easing, I don't know, are we up to 25 by now? When will we return to classic liberal laissez-faire market economy? That is the question this morning. It's a bit over the horizon on some level, but I think it speaks to the immediate term of the next few years as to, will we continue to see such generous stimulus manage the G7 economy? So I welcome people's views on that question. It may have some thoughts on the immediate. Christoph, looking to that question, the big talk next week in Washington is to finally the rubber meets the road on this $1.7 trillion infrastructure bill that has been in the debate now for a few months, and there is, some horse trading still to be done. Your thoughts on the outlook for it and what it would mean for the markets?
I think it will be done more or less. I mean, these big projects never pass completely unharmed, but it looks as if it will be done with some corrections here and there. I do think that it's a race over the next 10 years with that program, whether you can build up capacity faster or whether you run into constraints and you get price increases. I do also think that the Fed is going to support the fiscal expansion. That means that they will not put a brake to these price increases. So I do believe that we have in front of us a period of rapid growth in 21, and then also more or less regular inflation, 3, 4, 5% perhaps over the next few years. And there is the danger that this gets out of hand in a world which hasn't seen inflation for 25 or 30 years. I cannot fathom a situation where those managing, as you call it, the economy, would find another way out of these enormous debt levels, rather than having sort of very high nominal GDP, just technically nominal high GDP growth supported by a little bit of inflation, because that then will erode the debt, which is fixed in nominal terms and doesn't adjust. If you had zero inflation, the economy would have to grow at 3, 4, 5% in real terms. That's not feasible in order to grow out of this debt, and you would have a problem by having to pay it back in real terms. The burden would have been too large. Having said all this, one comment to the question, John, I would be very careful. A loose monetary policy or even inflationary combination of fiscal and monetary policy, as opposed to some very strict structural reforms and what people like me would like to see happening, that's not the same as a managed economy a la China. No? I don't think we are there by any means. And China's problem is much more severe, because they always when they have a problem, they clamp down more, and then they liberalize a little bit, and then they get nervous and clamp down more. It's always 2 steps forward, 2 steps back. If there's a big crisis in the world again, China is probably good equipped to answer. But in normal times, generating lasting high growth without eroding the financial sector, they are facing pretty much the same problems. The difference is it's just not discussed that much.
I think that way that we may be getting more, into that managed space. Over the weekend, the Biden administration telling everybody you can't invest in Chinese shares. I mean, this thing is going to go and go. But Mike, your thoughts the week ahead, where the oil markets could be moved? What will this consolidation above 70, and your thoughts?
Yes, so apart from Iran, which we'll clearly be watching, all eyes on demand. I mean, people still want to see the fallout of the long weekend and what impact that had on demand. And people are watching the aviation sector, because people desperately want to go on holidays. And there is talk of a transatlantic corridor. There's a mutual desire on the part of the UK and the US, for example, to see that open up again. And there's a huge question mark over aviation demand for the balance of the year, which is the one single biggest unknown in terms of how quickly the demand recovery will be about that final product which hasn't recovered, which is aviation fuel. I think we need to watch China a little bit more closely. It's interesting. But maybe before I go to China, the St. Petersburg International Economic Forum ended just this week. And as a parting shot, we saw a comment from the head of Rosneft, Igor Sechin, reminding everybody that there could be acute shortages of hydrocarbons amidst the drive for clean energy. Just reminding people of Russia's view that underinvestment is a big underpinning to prices, and that's the sort of message that I think hedge funds and sticky managed money might be taking into account when it looks at oil's place in the broader commodity cycle, with copper at $10,000 plus per ton, et cetera, et cetera. It doesn't pay to hold inventory at all. We have 50 cents a barrel a month backwardation in Brent and WTI, so destocking must continue from a purely commercial perspective, let alone regardless what OPEC do. So that's all working hand in hand. And then India would appear to be past its peak in terms of still tragic numbers, of course, but cases dipping below 200,000 and deaths hopefully petering out and stalling, although they're now at 350,000 or thereabouts. So back to China then. I mean, China has taken measures to exert control over the independent sector in quite a remarkable way, in terms of imposing further restrictions on the independent sector, eliminating inland blending capabilities, as per consumption taxes, clamping down on infringements on quality, and setting directives on things like resources allocation in the country. So there is a view that that's going to see China run its domestic refining segment harder, and that's going to serve to further draw on inventories of crude oil, which have been the one stubbornly high set of inventories, which is that queue of ships off China or heading towards China. And the market is growing more comfortable, I think, pointing unsold oil towards China in the knowledge that demand is there. Now, I have said in previous months that China hasn't really got much to grow because it did all its recovering from the pandemic already. But I don't think we should talk about China as having plateaued. I still think that economy is looking pretty good, regardless of all these anecdotal stories I gave. There were a couple of interesting people chipping in on the chat screen here, just to go into the line.
Yes, I see it, yeah.
$10 billion deepwater projects off West Africa are indeed the very projects that companies like Shell, Exxon, Total are going to be scratching their heads and wondering whether they will ever go into those. New refining projects, I mean, given the IEA's latest directive, you just don't know whether the world is going to want to build those 6-7 million barrels a day of refining that is going to be needed, if you believe those who say that oil is yet to peak and will peak in the mid-30s. Otherwise, there'll be a shortage there and price will have to solve. And then look at what's happened to the ExxonMobil board. I see they've now voted a third director in from the engine number one team, in addition to the lady that transformed Neste, and of course Greg Goff. And Wan Zulkifli, the former chairman of Petronas, only had a few months on the board of ExxonMobil and wasn't re-elected. That is
That's sort of a
very
shift,
interesting.
A generational shift. Let's get this survey result and give Christoph the last word this morning. Never at 38%, 31 at 25, and so forth. So that's a question to keep on asking, I suppose. Christoph, on that, we have the G7 meeting this weekend, the decision to come into some sort of global alignment around corporate tax rates. Is that of any immediate significance? Your thought for the week ahead?
Yeah, I think that's very important. So when we talk about managed economy, that is also about the attempt of the US to mend fences and to get back control over the international agenda. And that corporate taxation bit is of vast importance in sort of trying to establish a unified front of the so-called the West, for lack of a better name, moving back together OECD countries essentially. Secondly, I do think in the big scheme of things, one has to be a bit selective, but one which is important is the Sechin statement. As you know, I have consistently always argued against the danger of investment bottlenecks in oil as the result of normal ups and downs and crises. But as a result of this energy transition and the policies and the moral pressure associated with that, it's conceivable that he's right. It's conceivable that investment projects get cancelled and the NOCs are not quick enough to react, so that we will get not only a more concentrated production that we will have, OPEC will be very happy because we kept alive by that, but also much higher prices. That's a serious possibility. And then on Asia, I think what we see in China, I don't know what it means to plateau, but in terms of growth rates, it certainly has plateaued. China is interesting because it's 1 or 2 years ahead of the rest of the world in terms of COVID recovery. It had its flash in the pan. It's coming down now. Down is relative. Down is still 6-point-something% growth. But I don't see China sort of escalating that to 10 and taking the world with it. I think that role will remain with the US for the time being. In India, we have done that topic before. I think that people have started to divide the fatalities by the population and it returned to normal. The picture, unfortunate but normal. So I think we ought to be optimistic. And for oil demand, yes, all eyes are on the ball of demand. Sorry, for oil prices, and for the longer term, expect some sort of backlash about this energy transition, because investors will not stupidly run into ESG funds if they see that there is trouble on the horizon of the sort of we're not having enough oil. That's a big warning signal if it starts to get around.
Well, it's hard to see how we get through the next 5 years without getting to $100 oil is my sort of view. But that is where we will wrap it. Christoph and Mike Muller, that was like the Wimbledon final. All I had to do was sit in the sidelines and keep my mouth shut. But thank you very much, Mike. I really appreciate your insights. Have a great month of June. Christoph, thank you as well. Really appreciate your presence again, and we look forward to having it every Sunday through June. Just again, we're flagging 4 months out the first live energy markets event that will take place in Fujairah on October 4th and 5th. Mark your calendars, book your flights, and we'd love to see you there. Hopefully, it will be a world in which we'll all feel very comfortable making such trips. Thanks,
Sean, that is very significant because Singapore just cancelled the Formula One Grand Prix that's happening 3 days before your conference. And really? That probably means that APEC will be virtual. So indeed, Fujairah may be the first face-to-face event. If Gastech is cancelled, and there's a strong rumor that might not work in Singapore either, you might be the historic event that convenes people, human beings. So let's hope so.
We'll have to bring therapists with us. We'll have to bring masseuses and everything. Listen, just hopefully for no other reason than mark your calendar and hope that by the time we get there, everybody will be comfortable getting on planes and will be permitted to move around with some relative place. So again, thanks everybody. Have a great week. We'll catch you in the coming days. All the best. Thank you.